Good morning, everybody. Welcome to See the Futures. My name is Jim Cagnina with NinjaTrader. Today is April 19th, 2023. We have a great guest lined up for us today. But before we get started, let me remind everybody, trading futures, options on futures involves substantial risk of loss, and that's suitable for all traders and investors. Oftentimes in futures trading, you have a high combination of leverage and volatility. And although that could be an equation for opportunity, it's also an equation for risk. So be careful. Only fund your futures trading account with risk capital. My personal definition of risk capital, money I can afford to lose, doesn't change my lifestyle, lengthen my retirement horizon, or overly stress me out. As a human being, I make bad decisions when I'm under stress. So be in a good spot. Remember, micro contracts can be friends. Easy on the day trade margins. No, it's usually not best practices to max out on those day trade margins on a regular basis. We will be taking a peek at a real-time simulated live NinjaTrader trading platform today. None of this should be construed as trade or investment advice, and past performance is not indicative of future results. All right, folks, thanks for being here with me live today. Jimmy Iuorio is with me today, side by side. Jimmy, good morning.
Morning to you. Thank you for having me again.
Appreciate you being here for sure. We're living in interesting times, that is for sure.
Yeah, which is funny because this is somewhat of actually an oddly calm week among these tumultuous times. And I think part of that is because it's been, when did we start to get the first whiffs of the banking crisis? I believe it was about March 8th, March 9th. And, by March 17th, we were in the thick of it. But since then, as each week has passed, it seems like we talk less and less about that. And the market seems to be confident that either the Fed has it under control or it's not as widespread as we initially thought. I have some concerns about that attitude, but I think the fact that the big banks are now reporting and people are looking, look, the banks are reporting and having decent earnings, that means it's all fine. No, it doesn't. Those are the big banks. We never had any questions about the big banks.
Right. Aren't they the beneficiary of some of these small bank troubles?
Of course, not just are they beneficiary of the troubles by depositors leaving the small and regional banks, that Janet Yellen looked us all in the eyes and said her intent was not to support those depositors, but also the bigger banks tend to be the ones to hedge their interest rate risks better than the smaller ones. I believe they do have probably more sophisticated, mechanisms for that. And again, and I've said this on the show before too, the fact that this all boils down to the fact that they had this portfolio, I'm talking about SVB and whoever else might develop here, had this portfolio of bonds that were losing value. That's what me and my team does. 60% of our business is banks calling us to hedge their bond risk. It literally is a 5-minute fix. It would have cost them a little bit of money, but it's way cheaper than going bankrupt.
Oh yeah, that's for sure. But so, it's funny. We were talking about this morning. And I was, we're in a low volume environment the last 10 days or so. It's not low relative to history, but low relative to the last 18 months, right? We're not seeing a lot of volume in any of that CME group asset classes that we're used to now.
So yeah, I think that's a function of the inflection point that we're at. Like, we know that we are going from a Fed tightening cycle to either a pause or an easing cycle within the next couple months. Everybody's on the same side of that trade now. The Fed funds futures market predicts 90% chance, almost 90% chance of a 25 basis point move at the May 3rd meeting, and then a small ease by the end of the year, but 175 basis points of easing by the end of next year. Point being is that there's not enough disagreement to fuel huge volume right now. It seems like something kind of needs to happen to push it one way or the other. Everybody thinks it's clear sailing in this direction, which every time that happens, it seems like they're wrong, but that's what seems like we're in right now.
Yeah, and the Fed, just tracking the Fed funds, CME Group Fed funds tool every day like we do. You have this situation where we had just weird kind of initial, we're cutting all the way to 2.5%. Now it's kind of consolidating toward the middle again, which seems more reasonable to me.
Yeah, I think there's no question it's more reasonable. But think of where we came from as well. Back on March 17th, in the thick of it all with the banks, there was a 20% chance of probability in Fed funds curves that they were going to ease at this next month, at this next meeting. And there was only a 20% chance they were going to go 25. The majority of the market participants believed they were going to do nothing. So it's been a gradual move, like you said. It seems like the pendulum, even in the futures markets, the pendulum swings both ways too far, and now it's meeting back in the middle. And that is funny because it kind of fits in with the metaphor of our little bit of calm that's happening right now as that pendulum starts to settle in.
Yeah, and you still have most of the I think, in my opinion anyway, most of the FOMC members are reading the script, and there's a couple of people that aren't, that are just Bullard as an example, being a lot more hawkish than everybody else. But the idea seems to be coming across: one more rate hike, we're going to wait a while.
Yeah, and again, remember, these guys have to talk tough right up until the point that they don't. Meaning, it's pointless to be in a hiking cycle if they've decided that they believe, even if they're only 60% sure that a 25 basis point hike at the next meeting is appropriate, they have to talk the talk to back that up, because it takes it away if they start saying, we're not sure what we're going to do. Then all of a sudden the market will begin to reprice, and they can't have that. So that's why I remember we talked on this show, it was about a month ago or so, that the market was pricing in just moderate eases toward the end of the year and the beginning of next year. And I was like, no way. If they are switching to easing, it's because the building is on fire. And there is no possible way, in my view, that there's going to be like let's just do a quarter point ease. They're going to be in a panic if they need to ease. Does that make sense?
Yeah, no, for sure. For sure. And the data that we're seeing, it's almost like scripted perfectly, right? We're seeing, slow, inflation pictures kind of slowing down. The jobs market kind of getting weaker in a real small, subtle way, but it seems like it's almost like a perfect present for the Fed.
It is, except for one thing. The last read on CPI came in at 5.0, which shows a pretty much dramatic decline from 9.0 back in June to now. However, it reflected those sub $70 crude prices that were like from March 13th to the end of the month. We no longer have that luxury anymore. And I'm so glad you have a crude chart up there, because I think crude is probably one of the most interesting stories right now. And now into April, crude is back high again. So I've been an inflation's over guy for 3 or 4 months, but now I'm kind of have this carve out that we might see a bit of an uptick as crude prices go a little higher.
Yeah, Baker Hughes came out with their earnings report today and said something about their 2023 outlook being tight, right? That supply and demand is going to be tight throughout the whole
Sure.
year, and they have some pretty good data.
So can we start with crude then? Because that's the top of my list, and we just kind of talked about it. So can we look at that chart?
Absolutely. This is a June contract. I have a daily chart here.
Right. I think this is a big deal. So here's what the conflict in my mind is. I believe that there's a desire by the asset to fill that gap down to where it broke out from. I don't believe that's going to happen. But here's the way I'm trading it. If we can settle the market back above, call it 83.25, 83.5, up there, you see all those highs. If we can settle it up there, I believe we're going to 100. Now, this does not help day traders all. This is obviously a medium to longer term trade for me, and I have part of it on just as like legacy longs, but I'm going to be adding longs on a settle above that area, and I think we shoot higher. And the fundamental story supports it so much. And for those, I know most of you people know the story too, but as we drain the SPR, we kept selling and pressuring crude, let's say going into the election. I'm sure it had nothing to do with politics at all too. There's a whole group of OPEC nations out there who are a little bit irritated that we keep depressing the price of their asset. The whole time we say we're going to restock at 70, it gets to 70. The United States government pulls their bids out, says, we don't really want to support the price anymore. So now the OPEC nations get irritated, and right as soon as it starts to head back higher, that's when they announce their production cut. It jumps that whole gap and really hasn't given it back yet. This is a really kind of interesting, almost a comedy of errors on our part, why crude is higher and why I think it stays higher too. And like I said, I think that's going to be my big trade of the second half of 2023, provided we get that settlement.
So that's it. So on that note, and I'm always interested in the question: are the frackers, the Permian Basin folks, are they our secret weapon? Right? Could we flip a switch, get those guys moving? I know there's CapEx and there's a startup period and all that stuff, but is that still the force it was in the early 2000s?
I do, but I think, like you just implied, I think it takes time. And I think there is probably, again, by the way, when I describe my trading style, it's 60% technical to 40% fundamental. So the fundamental story here, the way I understand it, and it comes no guarantees with me saying understand it, is that there are higher regulatory hurdles now, and it always did take a while for them to adjust and get it. Doesn't just, you don't just flip a switch and get them all firing on all cylinders again. So as demand starting to pick up, and you saw those numbers out of China, China is importing more crude oil. Their GDP came out 4.5%, over expected 4% for the first quarter. And again, I'm not silly enough to believe every number that's coming out of China. So please don't anyone out there accuse me of that. But I do think as an aggregate, you can get a pretty good picture. So China's all of a sudden coming back online. I think that that we will be playing catch up, trying to get our wells going again, or our fracking going again.
Okay, I see that. You know, one thing I wanted to mention to you. So Friday, I was fortunate enough to get a behind the scenes tour of the Port of Carolina here in Charleston. So I was, you know, on the dock, you know, longshoremen everywhere, boats being loaded, unloaded, and they were telling me they're pre-COVID busy, 7,000 container trucks coming in and out every day, and most of them coming from Singapore. So that Asia traffic there is really, really strong right now. So, you know, maybe there is demand and supply both coming back at the same time.
I believe that too. And I believe there's a weird bifurcation to our economy. I think there was a huge transfer of wealth over the last 3 years. I think the lower 50% in our economy are already in a quasi-recession caused by, you know, higher prices, and people are genuinely suffering. But I think people who have money have lots of money, and that's what's fueling still the I won't call it a facade that we're not in a recession, because I think technically we're not in a recession, but I think it's a weird, and everybody is not participating in this economy equally. And I think that the higher end people are fueling huge global traffic.
Yeah, no, I hear you. Even the housing data though recently came out suggesting the multi-housing units are taking a big hit. Single families not taking a big hit, and maybe commercials taking a big hit.
Right, and that just feeds into what I'm saying is that single family people actually with money are doing okay. It's really a sad state of affairs. And if you think about it, again, I don't want to deviate from markets too much, but it is kind of the whole psychology of it. It changed us into a haves and have-nots we were to begin with, but it really exacerbated that difference, the policies over the last 3 years, educationally, emotionally, and financially.
Yeah, absolutely. Absolutely. So, all right. So we talked about crude oil here. We'll see if that gap gets filled sooner than later. You know, I've been warning people, though. I want to warn people now. Sometimes gaps don't get filled for a long period of time. So the trading strategy, you know, it's not a slam dunk to say, hey, as soon as we break on into this area, this gap here, I'm selling, because it's going to go all the way back down to fill the gap. Just be careful of that.
No, and I agree completely. And that's why my roadmap for me is pretty clear, because I do think, and I'm curious if you agree with me, if I get my settlement that I want, and it's above all the traffic of the last 2 weeks, 83.5, I believe that gap won't be filled and it's just going to be ignored. What are your thoughts on that?
Well, so I think a little bit here. I'm going to draw a rectangle to tell you what I think. I'm thinking that the business now is pretty tight, right? There's a sweet spot I think Saudis and everybody else want, and I'm just going to draw this kind of channel here. So this sideways channel here, up and down, up and down. We had this dislocation down here during the banking crisis. We popped back up. OPEC surprise. We're in the middle of this kind of price happiness, I'm going to call it, right? The 70s. Right. Now, in my opinion is, yeah, maybe if we do get a breakout on the upside, we might see a similar kind of move that we saw on the downside. But I think it's going to be I think it's going to be short-lived. I think we'll end up back in this price happiness range.
Cool. That's what makes it trade. And by the way, I think at current, like when I see it come back into that range, like I'm not confident I'm going to get my settlement. I still think it fundamentally in my mind favors that, which means nothing to me. And I don't mind. I think we could be going back and challenging that gap relatively soon.
Yeah, but then again, I don't know. I don't have a crystal ball, and I've been wrong an awful lot of times. So.
all you have to do is be more right than you are wrong.
Absolutely. I know we didn't script this ahead of time. We didn't talk about this at all, but I want to show a gold chart. Yep. And just get your opinion here. I'm kind of surprised we're still over 2,000. And Bobby's
So,
not. Bobby's like, we're going to, the moon.
see, I think too. Okay, so here's my fundamental story on gold. So if all of a sudden the Fed has to start easing, like the market is telling us that, and I'm hoping the gold market is a bit forward looking, they're going to ease significantly. If they're going to ease significantly and start throwing money at the system, it'll mean because things are locked up in the macroeconomic corporate sector. So of course, some of that money will go to risk assets like stocks, but not as many as normal because those are the same companies that are probably having difficulties if they have to flip that switch. So to think there's some escape velocity that heads into the assets like gold, silver, Bitcoin, Ethereum, I think is a very reasonable way to think. And I have been long gold and I've been pitching it. The one thing I really like today, and again, I'm curious to get your opinion about this because I know you're not afraid to tell me when I'm being totally wrong and pig-headed, is that I think the fact that we headed below 2,000, 2 of the last 3 days, did not feel comfortable there and have come back up. Now I think we take out the high just from yesterday, the high of that green candle from yesterday. I think we start to head back higher again. Do you think that's reasonable?
Absolutely reasonable. I do think it's reasonable. And so when I say I'm surprised we're above 2000, kind of the follow-up with that is I think we could stay above it, right? So we have, we have some big wicks here. We have buyers, buyers rejecting prices down at 1980. We have buyers rejecting prices down at 93. And it's kind of pushing back up. So absolutely, I do agree with that. Do I think we're going to? I'm not as bullish as Bobby is, but I think we could stay up higher.
But one more point to that too is everyone, if you look at the long term, I think it's a 5-year to 10-year chart, and 2000 was obviously a level that was of massive importance. But how are we to say that it hasn't changed, considering the value of the dollar's changed? We've inflated the hell out of everything. To me, that 2000 level is what 1600 was 3 years ago. So yes, psychology is one thing, but reality has to swamp it on occasion.
Yeah, that's right. And this is gold priced in US dollars. And, there's investors around the world that are investing gold priced in yen, gold priced in different, right. You're exactly right.
Precisely.
Yeah. Love that. So anyway, again, I'm open-minded a little bit on gold, but I was surprised initially. And then I kind of, okay, this is the new paradigm. Let's kind of live with it. Equity prices were rallying. Gold was rallying. It was a lot of green on the board for a while.
Right. And I'm long gold, and I will probably get longer gold if we can get a settlement, probably not today, but above yesterday's green candle. Can you tell me exactly what that level is?
Yeah. Well, I'm going to use my little mouse. The high of yesterday was 24.60. 20, right? Yeah, 2024.60, right?
Oh, yeah.
Yesterday.
24.60. Right. Yeah. So call it a high above 2025, which is another little bit of a psychological number, a settle above there. And I think it's game on. And I think we head back to those highs.
All right. Well, we'll keep an eye on this, on taking, as we like to say, taking out this wick.
Right. Exactly. Can we look at silver as long as we're on gold real quick? Because I thought something happened interesting in silver the other day.
Yes, sir. Let me just toggle over there. It's really easy to do with the NinjaTrader software, everybody. Look at that.
The NinjaTrader software, yeah.
Is May the right month? I think it might be. Let's go with it.
Okay. May's fine. Because here's what I saw that worried me is we had that encompassing candle. What do you call it? The one from 3 days ago, where a higher high and a lower low, and we closed on the lows.
Yeah.
Right. And then we had
a bearish engulfing candle.
Bingo. That's what we call it in candlestick, bearish engulfing. Which, by the way, like I look at it, I look at it like a higher high and a lower low, closing on the lows. We all look at the same stuff. Just candlestick makes it a little bit easier sometimes. But anyway, then we saw some weakness the next day, which I thought could have suggested lower prices. Now that ran into my major support level of 25, came below 25, got rejected. Came below 25, got rejected hard today. To me, this is a very I will abandon that thought that we were reversing and needed to plumb some lower lows. So I think if we can close strong today, I like the silver trade as well.
Yeah, and I like to draw rectangles when we do our opening range show. And what the rectangle does is it just shows me the area of support or area resistance, here area support. And it's not always a number, right? We get a lot of volatility. So when I draw these rectangles, it helps me visualize. And the rectangle I would have drawn is right at that 25 number that you just said.
Good. Yes. Again, we all have different ways of getting to it, but oftentimes we get to the same levels, which I find interesting.
Yeah, no, I know. Technical analysis, it's not like Sasquatch. It exists. It's a real
It
thing.
exists, it's real, and it's about momentum and it's about psychology. People look at it, it's like a randomness. It's not a randomness. It's about what people are thinking and why.
Yeah, absolutely, absolutely. So that's the story of silver. We do need to talk about the stock index futures. You could pick which one. I could toggle any of them. I have the E-mini S&P up here.
Yes, yes, it's fine. Yeah. So
Daily chart again.
it's obviously having some difficulty at the right. Obviously having some difficulty at the 4,200 level. 4,200 has been a problem 3 different times in the last 4 months. That is. I'm neutral on it. I won't be neutral if we can settle above, call it 42 and a half to 42.50 to 42.60. Do you want to draw that up there?
Yeah,
You guys will be able to see why, obviously.
I'm gonna get it. Hang on a second. There we go. More or less.
So yeah, so that's the level that I'm looking at to convince me that we're going to head back to, I guess, what would be all-time highs now. I mean, can we make that chart a little bit more time to see what the next level would be and why? I know I remember thinking that. I have to figure out why I think that.
Yeah,
Yeah,
I know. I understand why. There's so many great markets here, right? So here's the next target wick we want to take out, right? Maybe.
Yeah. So if we do that, it will give credence to the move that began in October with higher highs and higher lows. And to me, it'll just seems like the whole bearish thing will have been invalidated. And now I believe we would be heading to all-time highs if we can settle above that level. But until we can, I'm relatively neutral. I may even be inclined to take some shorts against it to see if it can reject a few more times.
Yeah, and there's been a lot of discussion lately about, and I'm interested to see how you feel about this on the news of how we're not out of the weeds, but in the equity market, but we're entering the weeds. In other words, a lot of sideways uncertainty for a while.
So I think that going sideways is that makes more sense to me than anything else. But within that, I think there's money to be made. Like I said, if we can get over that settlement, we can start threatening those all-time highs again. But to take them out and start making any real new bullish ground, I think something fundamentally would have to change. I don't think we're doing that anytime soon.
Yeah, I'm just always surprised that, I'm down here in the Charleston area and it's construction cranes, building, everywhere you look, help wanted.
That could be reflective of something else though, too. There's been an enormous migration from north to south so I think the fact that you're seeing tons of construction and tons of migration to Charleston might not be indicative of the rest of the country. Do you agree?
Yeah, well, we saw a lot of that in Charlotte also. We spent some time in Charlotte also for sure. Absolutely. But in any event, okay, so that's interesting on that particular market. Any other markets you think we should keep our eye on that might be in play a little bit?
Can you get up the 2-year micro yield? If we have enough time, I'd like the 2-year micro yield and then maybe even the dollar index.
I can't do the dollar index, but I could do the 2-year.
So let's do the 2-year then. So here's what I think is interesting here is that to me is technically a great and strong pattern. You know what I mean? It almost looks like a reverse head and shoulders. Is that what you call that too? And then when it breaks out that line from that red candle from about 2 weeks ago, to me, it looks like it's heading higher. Now that flies in the face of some of the other things that I think are going to happen. So that's what I'm keeping an eye on to see, because I think if we all of a sudden head yields back up to 4.25%, 4.5%, that could weigh on risk assets pretty easily. So what do you think of that? Doesn't that look technically pretty strong?
It looks technically very strong. I mean, if I'm just comparing tops to bottoms here, loosely fitting Fibonacci retracement line, we're above the 50% retracement. And, from my point of view, we're above 4, then we're still kind of in that FOMC, no man's land. We're below 4. That's in the right direction because this is the part of the yield curve we want to be lower.
Right. So maybe the other markets, maybe the risk assets are saying that 2-year doesn't matter as much because like you said, the short end is what we want. I mean, higher rates is what they want in the short end. And maybe it doesn't matter until we get to some uncharted waters, which would be above that. I think it's 4.6 above there. And that won't start weighing on risk assets too hard until we get above that. I have a hard time believing that, though, because it seemed that risk assets are very, very sensitive to moves in rates. So again, this is a screen that I have on board. And if we start to see a lot of gains in the 2-year, I will be more reluctant to put on longs in stocks, gold, silver, copper, etc.
Okay, so that's great information. Let me ask you this question. If the Fed sees this, does that change their point of view? If we're driving back up toward a 5% 2-year, is that going to change their point of view?
It might. I think it definitely could. I think it's all the things that we think should be the Fed's sophistication level. This definitely falls into that. I think some things people are like, well, do you think they look at this thing like this? No, I don't think they look at that. But I do think they look at where the 2-year is, and that they like to feel that they're in control. They want rates on the short end to be higher. They look at this and say, okay, we're doing our job right here. If rates were cascading lower at the same time they were tightening, I think that would get them a little bit angry, and they could anger tighten, which, by the way, so do I think they're capable of getting irritated if rates were lower, even though they were raising rates, and then have a knee-jerk reaction to it? Absolutely, I think it's possible.
Okay, I mean, it's something everybody looks at. It's just not me and you. I mean, everyone's looking at this yield and scratching our heads.
Right, exactly.
Yeah. So,
right.
Yeah. So we'll see if this is a real move up or a consolidation move sideways. It's looking like, I agree with you. It's looking strong. It looks like it's about to bump up, which means, remember, guys, it's inversely related to the underlying Treasury futures instrument at the CME. So if that's the case, if you're bullish here, you want to be bearish in that market.
Exactly. Yeah.
All right. Well, we covered a lot of ground today. What's the best way for people to reach out and say hi to you?
Okay, so I love the Twitter conversations that we have with people, except for some of those nasty trolls. But it's at Jim Iuorio, which is JimIuorio. And also the Futures Edge podcast. We had Jim Bianco this week. Do you know Jim?
I don't know him personally. I see him on Bloomberg Surveillance. I see him on your show. I think he's wicked smart and very good in his analysis. He's a glass half empty guy sometimes.
So he can be a glass half empty guy. But again, I consider myself sometimes glass half full to a bit of a fault on markets. So it's sometimes hard to get your needle to point straight up. But yeah, I do sometimes think, I mean, he definitely will try to find where the, let's call it where the gaps are, where the flaws are in the analysis.
Yeah, no, and I do follow him on Twitter also. He has very long feeds, with several different threads on it. And so you get, it's not like just looking at a sentence and like, LOL, you got to read it and think, which is what we want to do. We want to think. And that's what he provides us. So,
that's what I like about him. Yeah.
Yeah, for absolutely sure. Any other upcoming guests we should have our radar screen up for?
No, Bobby handles the guests, so I usually don't know. We did do Vivek Ramaswamy 2 weeks ago, the presidential candidate. And I found his, and again, I don't know who I support at all. I just like a broad conversation regarding macroeconomic policy. And he seems to be one to be bringing that to the stage. And again, I think that he's radical in some areas, and I'm not even very political, but I like to talk about macroeconomic policy. And that was a pretty good episode, I thought.
All right, sounds good. And I'm going to leave you with this train of thought. We're up against time. I'm going to leave you with this. So I worked for the federal government for 6 years.
Okay.
And I will testify that no matter who the administration is, most of these departments and agencies and people are good people, meaning to do right, and dedicated to doing right. And that's just been my experience. I think is true. Across parties, doesn't matter who's the guy at the top. So anyway, I just want to throw that out to you.
I love it, and I appreciate that. And because sometimes that I get a little cynical in my view, and I like to hear something that challenges that. I appreciate that very much, Jim.
Yeah. No worries. All right, we're past our time. Really appreciate you being here, Jimmy, with me side by side. I want to thank you for that, for sure.
My pleasure. Thank you. Have a great day.
Yeah, and everybody else, please remember, most important message: be safe out there and be good to each other. Thank you.